All right. Hello, everybody. Welcome back to another episode of The Market Close. It is Thursday, July 18th, 3:50 p.m. In about 10 minutes, we are starting off big tech earnings Q2 with Netflix. Now, we've already started earnings. We've had the Domino's of the world. We had the Deltas of the world, the United of the world, the JP Morgans, Bank of Americas, etc. And all of them have done relatively well. But we've got Netflix on deck, and that's going to start the next level of big tech earnings. Next week is also going to be really crazy because we got Tesla. We got a bunch of other companies coming up. So we got a lot to talk about. Now, before we get into Netflix, which is going to start in about 10 to 15 minutes, we got to take a look at what's happening in the markets. And the markets, quite frankly, have been very confusing today. I'm trying to make sense of it, so I'm going to do my best to try to make sense of what I'm seeing right now. But my overall argument based on the action I'm looking at in the market is that the market still wants big tech. They just don't want big tech as much as they wanted at the beginning of June. Why do I say that? So Palantir right here at 28.71, we did hit 29.83. Then we went all the way back down to 28.25. Now we're here at 28.71. So nice momentum into the close. It's not at that 29, 15 level, 29.30 level that I thought we could close at, but still doing well at 28.68. Nvidia, I think, tells us a lot right now. So we got a red candle right here on Nvidia, but we're still up 2% on the day. Nvidia was down at 116. Nvidia was down at 116. And Nvidia was up at 122 in the morning. So we saw the retracement. And when we saw that retracement, the goal was for this bad boy, small caps, to take advantage of that retracement, and small caps refused to do that. The IWM is down 2% on the day. A lot of people felt the run was going to start on IWM today because Nvidia sold off yesterday. Nvidia was selling off this morning. So it's like, all right, 2 bad days in a row for the semis. In general, the semis have had not the best day today. They recovered into the close, but they were having a worse day. SMCI is down 2%. That was a little bit worse. AMD was down 2%. Intel was up 5% because everything else was down. Now Intel's up 1%. TSM closing or going to close green, it looks like, even though it was down at 164. So it seems like intraday, probably around 1:30-ish, I would say, the market decided we are not going to let the major semis sell off dramatically. We are going to buy the dip. And as a result, money comes back into GPUs over unprofitable growth companies like small caps. Now, the QQQ is down. QQQ had a very interesting day. If we look at the QQQ today, so the QQQ went up all the way to 500, or sorry, that was on July 18th. QQQ today went up to 485. Now we're down at 479. We were down 2.94% yesterday, down another 0.43% today. It was worse. We got to 476 at one point. So we are up from the lows, but we still are down on the day, along with the S&P. The S&P at one point was down 1%. We were looking at 550, potentially going below 550, now at 552. So over the past 2 days, the S&P is basically down 2%. We haven't seen a 2% day on the S&P in just one day in 350 days, right, in a year. But we are seeing now 2 days in a row where the S&P is red. And quite frankly, it's probably realistic, right? This is just realistic to see some of this downside momentum. So my overall take on the markets today, Netflix right here, basically down 1% on the day, is that it's not that big of a deal. Bitcoin also down 2%. That's what messed up Robinhood. Robinhood was having a great couple days. Bitcoin fell, Robinhood fell. But I also think Robinhood fell because the broader market took a hit. Obviously, Robinhood is a bull call in the market. And S&P, QQQ, when, those fall 2% over the next 3 days or over 2 days, and the NASDAQ down almost 4%, then yeah, Robinhood's going to take a little bit of a hit. So Robinhood, if we could close above 23 or get back to 23, that would be awesome, because then we would be back out of that 22 range. But that took a hit as everything else took a hit today. So my overall thesis here is that this is just normal stuff. Big tech rebounding a little bit. So like we're down on the NASDAQ, we're down on the S&P. That's normal. But the companies that got, you could argue, oversold, like Meta at 462 yesterday, Nvidia at 116 this morning. Tesla's flat on the day. It was at 255. Tesla was actually a champ. It was holding up the entire day, but then it decided to come down. It was at 247, now 248. All these companies, they're just performing the way you would expect them to perform, which is that having a little bit of weakness after a massive run up in the month of July. However, some people are buying the dip on the ones that were massively oversold, which were you could argue the NVIDIAs of the world, the Metas of the world, etc. Now, Meet Kevin also did a bit of selling. He just put out this notification on his ETF. He sold Bitcoin, Palantir, AMD, Apple, NVIDIA, Tesla, and Amazon. He actually bought Palantir 2 days ago. So now he's selling decent amounts of all of his positions. I don't know if he thinks an entire major correction is coming. We do know August and September, and we're about 2 weeks away from August, tend to be the worst months of the year. And that's just kind of seasonally what ends up playing out. But this year's a little bit different. We have a September rate cut coming along the way. I think the market is still trying to question, is a rate cut actually good? Like, is it going to be a good thing or is it going to be a bad thing? I'm in the camp that it's going to be a good thing because the broader markets need that liquidity that comes from a rate cut. But we will see what happens when the cut, goes through and where the market is going to end up playing out. So that's what we got right now. I don't think this is necessarily a day to be nervous. Does that mean he sold the entirety of those positions? No, he just reduced those positions by XYZ%. He didn't sell those entire positions. I don't think today is a day to be nervous at all. I think this is one of those things that's just natural. I mean, do we think Apple at 240 on July 18th makes sense after, not even showing any growth in the previous quarter? Probably not. And maybe they're not going to show growth in the next quarter, but they got to show something that justifies the narrative of them being up 20% year to date and adding, what is it, like a $400 billion. And so if that's the case, yeah, it should take a breather right now, right? Like even Meta as much as I loved Meta at 530, I mean, I probably didn't deserve to be up 60% year to date after not really showing strong numbers in Q1. The numbers were okay, but the CapEx was up. And so the market wanted to know when that's going to start bottoming out and when we're going to get back to just top line growth, which is probably going to happen in Q2. We'll see if that happens, but I think the market is waiting for a little bit more proof before making that analysis. Palantir did get upgraded today by Dan Ives to $50. That's why Palantir is still holding on to its momentum. It's not at that 29.80 level, which was the top for today, but still a close above 28.50 again would be an incredible close for Palantir at these levels. And again, Q2 earnings is going to matter for Palantir. TNA, that's down 6% because IWM, that's triple leverage to IWM. Berkshire Hathaway is down 1%. So today, even value was not able to be a place where you could hide at, given the downside that we saw today. There really weren't that many 52-week highs on the day. I mean, there's a couple of value stocks that got 52-week highs. Palantir got up there, but then it came back down. But the Coca-Colas of the world, the Procter & Gamble's, the American Expresses, the Royal Caribbean's, or the Royal Bank of Canada's, Walmart's, they're all down, right? All of them took a beating. Really, there was nowhere to hide today besides NVIDIA. If you bought in at 116, that was your entry point to basically hide out from some of the downside action that we got. VIX is up 10% today. That is correct. And so why is the VIX up? There's a couple of reasons. There's not really any macro data that I saw outside of the job numbers coming in coming in higher than expected in terms of unemployment, which is actually good for cutting rates. But Trump is speaking tonight. And so I think the market's going to figure out what happens there. Obama, one piece of news that probably did spike the markets a little bit is Obama officially, from sources, and pretty much every news outlet is reporting it, so it seems like it's accurate, Obama said to Joe Biden, it's time to get out. And if that's the case, it does seem like the market is getting ready to figure out who's going to replace Joe Biden. Is the person that's going to replace Joe Biden having a better chance of beating Trump? Because if that's the case, that changes the dynamics of how the market's pricing in a Trump victory, which is, I think the market is at least pricing it in to an extent. And if they pick someone else who's going to do worse than Biden, right? Like, how does that affect the market as well? Maybe the market goes even higher because his chances of winning become higher. So I think we're going to see how that plays out. There are also some rumors that Elon Musk is going to be at the RNC tonight and giving a speech. I don't think he will. He probably won't be. I think we would have known by now if he was just through his jet, his private jet and all this stuff. People probably would have figured it out. So I don't think he's going to be there, but there are some rumors that Elon goes and offers his support before Trump speaks tonight. And so we're going to see how that ends up playing out by the end of the day. So uncertainty over Biden increased the VIX. Correct. I think that's one of the reasons why the VIX increased today. I also think after a red day that we got yesterday, the market was just there was no reason to buy the dip outside of the market wanting to buy the dip. Now, the market did buy the dip to an extent, but there was not any fundamental, something's happening, therefore we need to buy the dip. It's kind of one of those things where it's show me and then I'll buy. And Netflix in a couple minutes is going to really start this show off if they can prove that it's time for them to get some momentum. All right, Netflix numbers should be out very soon. 4 p.m. Thursday, July 18th. The stock market is now closed. There you go. It's up, it's down. It's up, it's down. So Netflix comes out immediately. Netflix does a good job. They actually release their earnings immediately, so we should get the numbers ASAP. It was up 2% for like a millisecond. Now it's down 2%. But last time it did the same thing. You can't really trust it. I will try to get the numbers. Let me see if I can find it. Now it's green after hours. Now it's green. Now there's green. Now we're up 2%. Now we're down 5%. Okay, now the numbers are in. I think now the numbers are in. Now never mind. We were down 3% now. Now we're down. We're down. We're down. We're down. Let me see if I can find it. Now it's down 5%. Now it's down 3%. Wow. That was pretty quick on Netflix, huh? That was pretty quick on Netflix. All right, let me see if I can get the numbers. We will see pretty soon how the street's pricing this in. Yeah, Netflix always releases their numbers first. Netflix is now down 2%. They just went from being down 5% to being down 2%. You guys see that red candle right there? They touched 600 for a second. Goodness gracious. Now they're at 615. Wow. Netflix touched 600. Netflix was at 658 today. That's insane. What do you guys think? Pump or dump? Pump or dump on Netflix? What do you think? What do you think? Nvidia's not 116. Now it's 121. It did get to 116, but it's 121 right now. Netflix numbers, I don't have them yet. Do I have them? Yes, I have them. I have them. Guys, I have the numbers. All right, here we go. Here we go. I'll start reading. You guys can look at the stock. 17% Q2 revenue growth. Operating margins are up 5% from 22% to 27%. We now expect full year 2024 reported revenue growth of 14 to 15%, up from 13 to 15%. So they're increasing full year revenue. They're increasing full year operating margin from 25 to 26. That is good. That is not bad. That is objectively good. So far, so good. Revenue was $8.1 billion, which is up 2.7% year over year. Net income was $1.4 billion, which is up 20% year over year, if I'm not wrong. No. Net income is down, actually. So net income last year was Sorry. Yeah, it's up. So net income revenue is actually $9.5 billion. That's up 16% year over year. Yeah, I was reading that wrong. So revenue, $9.5 billion, up 17%. Net income, $2.1 billion. That is up about 14%. Which is not bad. Global streaming paid memberships, 277 million. They have 277 million global streaming paid memberships. Global streaming paid net additions, 8 million. They added 8 million subscribers. The stock currently is down 5%. Stock's down 5%. Not that crazy of a swing. We actually talked about that in the morning. Netflix fell 20% last time. So the idea that it would fall another 20% this time, it kind of felt like the volatility was baked into it. And it would either go 5% to the upside or the downside. So free cash flow, 1.2 billion. Streaming paid additions, 8 million. And now they have 277 million paid members, which is up 16.5% year over year. Here's the actual balance sheet. Let me share it up right now. There you go. So these are not bad numbers. The growth is better than it was in Q1. Q1 growth was 14%. Now it's 17%. Q1 growth was 16% for memberships. Now it's 16.5%. That's not bad. It seems like it's okay. It seems like it's right. And EPS was 488 versus 329. That's up 48% year over year. Some engagement. Netflix, viewing is key to Netflix's success. It is the best proxy we have for member happiness. And when people watch more, they stick around longer. According to Nielsen, streaming accounts for 40% of total TV time, and Netflix and YouTube are the clear leaders. Now their argument is kind of just saying that if we execute against branded advertising, it's a $600 billion consumer market. Netflix market cap right now, close to $200 billion. Bridgerton generated 172 million views. I was not one of those people that watched it, but if you did, then that helped. The Roast of Tom Brady, I watched a little bit of that, 22.6 million views. And then games. In that time, we've seen how big existing games like Grand Theft Auto can be on Netflix. In Q2, we added Virgin River and Perfect Match. Starting in July, we'll launch one new game title per month, like Emily in Paris and Selling Sunset. Okay, that's a good idea that they're launching games based on the shows. We've known that for a while, but it seems like they're getting serious about it now. $625 on Netflix. It's down 2%. I think this is a good earnings. I think this is a success going into Q2. I think it's a success going into Q2. I mean, the volatility is very low, which is what you expect. I don't think any of us expected Netflix to explode to 700. That was not the expectation. But we did expect Netflix to have a little bit of momentum in their growth. And so that's good because at least they're growing and the stock is not falling off a cliff just because they didn't grow as much as maybe the street thought they were going to grow. Let's listen to CNBC and then we'll keep going from there. Is it turning green? Yeah, now it's down 1%. Yeah, there you go. Street's buying up the dip.
Netflix beating on the top and bottom line, reporting earnings per share of $4.88. That's ahead of estimates of $4.74. Revenues also coming in ahead of estimates, $9.56 billion ahead of estimates, $9.53 billion. And then looking at the subscriber numbers here, the company far surpassing expectations with 8.05 million subscribers versus the 4.8 million that was estimated. We do see shares dropping about 4% in after hours trading. We're going to continue to dig through here and get back to you with more. John?
Looking forward to that, Julia. And while we wait for more of those insights, let's get to Paul and Mark. Mark, a little surprised that based on these numbers, which sound like they beat at least the headline expectations, the stock is down, but there's always the whisper numbers and the question of what it has to hit in order to justify the valuation where it is here.
I think that's right. It's also one of the stocks, I call them the Super Six, that have traded up space 30 to 60% year to date. So if you were going to look for a high bar stock, it's right here. It's with Netflix. These subscriber numbers pretty much hit the whisper that was out there. The revenue came in a little bit light, so versus the whisper. So the question is going to be, are they having any issues ramping up advertising? I think they are. I think I'm pretty confident they'll be successful with it long term. It just may not grow as quickly as the street and frankly the company would like. This looks like a pretty decent print to me. And if you're a bull on Netflix, you probably got greater confirmation in the bull thesis. What I haven't seen yet, unfortunately, is the guidance that they gave for next quarter.
Speaking of the guidance, yeah, with that stock down about 4.5 at the moment, let's get back to Julia Boorstin, who has it. Julia.
Yeah, the guidance is really the reason why we see the stock now down 5% after hours trading. The company saying that it sees its third quarter revenues at $9.73 billion. That is below the consensus estimate of $9.82 billion. Also guiding to third quarter earnings per share of $5.10 versus $4.75 estimated. So that is so the earnings would be above estimates, but the revenues looking at below estimates. And this is a company that is really beating expectations on subscribers consistently looking back at the past couple of quarters. So the question is, if the company is beating expectations and subscribers, why is its revenue guidance for the third quarter below estimates, especially considering that it's going into Q3 with...
It's because that ARPU on the subscribers is coming from a bunch of APUs in India that can't pay the juicy premiums we're paying in the western part of the hemisphere, which is why the subscriber additions don't lead to the revenue addition. That's the reason.
So many more subscribers than anticipated. It really seems like that's at the heart of the stock trading lower right now. John.
Okay, Julia, thank you. Paul Hickey, I'll go to you on this one, especially as it does look like they also say that full year revenue guidance is going to be 14 to 15%. That's up from 13 to 15%. But we do know Q2 and Q3 do tend to be seasonally the weaker quarters for Netflix in general.
Yeah, exactly. I mean, former President Trump once said something about walking down Fifth Avenue. He could do whatever he wanted and people would still love him and vote for him. Next, Netflix could say whatever they want in their July report and the stock goes down. Historically, they've only gone up in reaction to the July report 23% of the time in its history as a public company. So it normally declines in reaction to earnings. And for most other quarters, it also does as well. The only quarter where it typically reacts positively is after it reports in January. So these are all short-term moves. I mean, just look at a long-term chart of Netflix, and it shows that these one-day reactions aren't too much to get excited about or worry about. And the longer-term picture is Netflix is still the dominant player, and as other companies are looking to exit the space or struggle, it's in the pole position. So okay. I think in short-term reactions, we shouldn't overreact to them here.
Okay, that makes sense if we're just talking about Netflix. But Mark Mahaney, the NASDAQ overall has had a couple of rough days, especially yesterday. And I wonder to what degree a name like Netflix that has had such strong performance overall was part of the Magnificent Seven to an extent that group is still together and the members aren't going solo. Is this going to give the market any confidence given this guidance number?
I don't think so. And Bentley, this thing is kind of on its own. I think the term is sui generis in Latin, but whatever. There's no real read through.
These guys have horrible metaphors. The Trump one failed, and then this Latin reference just not good. It's not the day for these. Just no.
Except that just from a stock perspective, look, the bar's high, and again, you've got any names that have materially outperformed the market year to date. Google's in that list, Meta's in that list, Amazon is in that list, Spotify is. It just tells you need to have clean beat and raise numbers for the stock to hold. I think just for the stock to hold. That's where the bar is on some of these names. So, I like Netflix as a stock. It's not one of my top picks because it's not dislocated. Now, you bring it down to 600, I'd get a lot more enthusiastic about it. But I still think it's a great running away with the pack story. What I want to hear on the earnings call is let's talk sports, let's talk about gaming, and let's talk about this advertising revenue ramp. That's what I think long-term bulls are really focused on. And if they do that, you'll probably find a lot of people buying the stock, tomorrow on this kind of correction, just like they did in the March quarter.
Yeah, but in the March quarter, the sucker fell badly, dude. It took a nice 25%. No, it was 30% nosedive. That's where the dip was exciting. I don't know if this dip is super exciting, but I definitely don't think the numbers justify a bad start to big tech earnings. It's down 2% right now. It was up 37% year to date. Like the market we're getting into the August, September time. The market's not going to give it some massive, massive juicy premium. The fact that it's not selling off dramatically, I think is positive. And they hit their numbers. Now, the guidance they did raise, that is correct. They raised it, but they didn't raise it as much as the street wanted. And that's why I guess the guidance is likely affecting it. But it's not like Netflix is a dying business. I personally miss the entire Netflix story because I never believed in like the business, like of just like paying for a content studio and then selling subscriptions. I never liked it. They've obviously proved it can work, and they're the only ones who can do it profitably. Pretty much everyone else is unprofitable trying to build streaming. That's why Paramount just had to get sold. But $277 billion. We're looking at an 8 times price of sales. They're doing about $35 billion per year in revenue, $277 billion market cap, PE of 37 right now for 15% growth, and not a monopoly, but a monopoly in the respects of they're the only ones that can actually do it profitably. But obviously, it's not literally a monopoly because there's just so much competition for content. I don't know. You got to really believe there's long-term growth drivers of Netflix to get it right here. So what they're saying about advertising is that they've increased their member base by 34% based on offering the ads tier. In the UK, starting September, Barb will measure Netflix's ad-supported plan, making it easier for clients to plan campaigns. We have also introduced new features like the pause or keep watching ads in the 2 months since the launch of the beta in May. We've closed over 60 deals with Coca-Cola, Ford, L'Oreal, McDonald's, Expedia, so they're getting some of the big guys onto the platform. Net cash generated by operating activities was $1.3 billion. Free cash flow, $1.2 billion. So net cash and free cash flow was down about $100 million year over year, which is okay. That's not the worst. We continue to expect full year cash flow of approximately $6 billion in 2024. Oh, they repurchased 2.6 million shares for $1.6 billion. So they spent $1.5 billion in the quarter, and we have $5 billion remaining under our existing authorization. So Netflix actually gobbled up 2 points. So Netflix thought they were undervalued, I guess, at call it 560-ish, 570-ish, maybe is where they got those shares, I would imagine. I don't think they paid like 620, 630 because we just recently got there. But there you go. That's what we got on Netflix. Netflix right now, after hours, down 3%. Let me see what other earnings we have today. And then we have their call at 4:45. We will watch their call at 4:45. Let me know if you own Netflix stock. I'm seeing a lot of comments right here saying that you guys have canceled your subscriptions. I haven't canceled mine because like we have a family plan, but I don't use it at all. Anytime I go to Netflix, it's very difficult to find any piece of content. After hours, we have PPG. PPG, they are down 2.75%. And then we have Intuitive Surgical, ISRG. I don't know those two companies, but they have earnings. That is up 6%. Okay. Intuitive Surgical had earnings. Yeah, does anyone own Intuitive Surgical? Wow, $147 billion company. All right, that's a big company. I should probably learn about Intuitive Surgical. Do they make intuitive surgeries or do they conduct intuitive surgeries? That made no sense. I don't even know. Like this is a problem when you listen to CNBC. You end up having horrible analogies and metaphors like those guys. Intuitive Surgical. It looks like they're a med tech company. Yeah, they're a med tech company. Here you go. PPG is a chemical paint company. Okay, so this is Intuitive Surgical. It looks like they make med tech products for the hospitals, physicians, etc. Okay, so I'll get their numbers in a bit, and then PPG is a chemical company. Robotic surgery. Oh, wow. Very interesting. Intuitive is close here by Mountain View. Robotic surgery. There has to be an AI angle there, dude. There's no way you're a robotic surgery company and you don't mention AI. There's got to be something there. Netflix is down 2.67%. Palantir is up a little bit after hours. NVIDIA up 0.38%. So NVIDIA now up a healthy 3% from today's action and then after hours so far. Really the dip in the broader market, but not in NVIDIA. Robinhood 22.88 after hours. Bitcoin 63,471 on the day. ISRG uses AMD chips. Yeah, I'd imagine. If you're doing robotic surgery, I would imagine you got to have some type of chips in there. ISRG makes the Da Vinci system. It's a robot surgeon. Surgeons love the machine. That seems more exciting than Netflix, dude. I'm going to put that on the watch list. ISRG. How much are they up year to date? ISRG stock year to date is up 25%. Wow. Interesting. This is up now almost as much as Netflix year to date. Okay, cool. So that's what we got right there on ISRG. We'll have Netflix at 445 and we'll see what else they have to say. A little bit more coverage right here on Netflix and then we'll keep going from there. And I'll get the ISRG numbers as well. Yes, there is some news on OpenAI. They approached Broadcom to make chips. Broadcom's not up because of this news, but it's interesting because Nancy Pelosi did buy a lot of call options on Broadcom. Maybe she knew that OpenAI and Broadcom were going to build chips and rival with NVIDIA. So we'll see how that news ultimately impacts Broadcom in the coming weeks.
To be aware of, as the S&P was at overbought levels for every day since the 1st of June through today.
Okay. Paul Hickey and Mark Mahaney, thanks for kicking off the hour with us.
Thanks.
Thank you.
With shares of Netflix down about 2% right now. Let's get back to Julia with more on Netflix. Julia.
Morgan, some more detail here from the company as it really pivots to focus more on the ad business. The company announcing that it is going to be phasing out the basic plan. That's the basic ad-free plan, starting now in the U.S. and France. They've already started that in the U.K. and Canada. They note that doing that, phasing out the basic plan, has increased the ads member base by 34% sequentially in Q2. But here's an essential thing here as they move away from this ad-supported basic plan and really push people to adopt ads. They point out that advertising is sort of a near-term challenge, long-term opportunity. They said we do not expect advertising to be a primary driver of our revenue growth in 2024 or 2025, saying the near-term challenge and medium-term opportunity is that we're scaling faster than our ability to monetize our growing ad inventory. They talk about investing in the tech capabilities, and that they go on to say we're confident that advertising will be a key component of our longer term revenue and profit growth, but they're describing here the challenges near term. Back over to you.
All right. Julia, thank you.
Can I ask a question real quick? Just Julia, is that them essentially saying they now have more space to sell ads and they have people willing to buy them at a price that they'd be willing to sell them at? I mean, is that the way I should read that?
Well, I think it's also what you're getting at here is there's a disconnect between the ad inventory that they have in terms of the number of people who are subscribing to the ad-supported option and the advertising itself that is a good fit for those audiences. Now, one thing I've heard a lot from the ad industry, from executives who wanted to buy advertising, is for a long time, they wanted to buy more ads on Netflix than Netflix could serve for them. And so there was a disconnect in that way. But here it sounds like they are scaling faster than their ability to monetize the ad inventory. So I'm sure there'll be some questions about it on the call, but just to try to dissect that language, it seems like that there maybe is a disconnect between the supply and the demand, and it sounds like the demand maybe is not quite meeting the supply. But again, this is one of those things where the ad industry is watching and waiting to make sure there's an audience that's large enough for the ads they want to buy.
Interesting stuff from Netflix. I could not sleep well at night owning Netflix stock, dude. It's just one of those that I just don't believe in, but people are willing to pay $630 a share for this one. If you've had it for a long time, it's probably, you know, something you keep for a long time, given you think it's going to grow. But I just like Netflix is just, I don't know. Even what they're saying about ads to me is like, I just don't believe that many people like Netflix enough to even want to watch ads on it. And maybe, and obviously that's subjective. I could be, you know, fully wrong there. I just never really liked Netflix as a content consumption vehicle. Some shows I like, some shows I binge, but outside of that, it's hard for me to see super massive growth. Also, they have almost 300 million people, dude. And a lot of those people are not paying the big subscriptions we're paying in America. So that's why we see a revenue disconnect as well. Shout out to Jarrett in the chat. So we're talking about ISRG. Jarrett says, I'm getting robotic surgery Monday to remove a huge tumor on my spine. So everyone can wish him good luck. Good luck to you, Jarrett. That is interesting to see. And it's interesting you mentioned that as soon as we're talking about ISRG. He says, my surgeons are super confident, like it's no biggie, basically zero recovery time. So basically that robotic surgery is having real life implications for a variety of people. See, this is why it's so interesting learning about companies. I had no idea there was robotic surgeries going on through a product named Da Vinci from ISRG. But that's what's happening. So ISRG results, company placed 341 Da Vinci surgical systems compared with 331 in the second quarter. Second quarter placements included 70 Da Vinci 5 systems. Company grew its surgical system install base to 9,203 systems as of June 2024, an increase of 14%. Second quarter revenue, $2 billion, up 14% year over year. That's not bad for a med tech company. Net income on a GAAP basis, $527 million or $146 a share. That's up about 30 cents from last year. And net income attributed to Intuitive was $641 million or about $178 a share as well. Instruments and accessories revenues increased 16% to $1.24 billion. The increase in instruments and accessories revenue is primarily driven by approximately 70% growth in Da Vinci procedure volume. So this Da Vinci product seems like that's the core product that they're selling. And that's the product that is really creating a lot of their growth. Second quarter systems revenue was $448 million, up from $393 million last year. Interesting stuff. So Intuitive Surgical, they are up right now. $147 billion company. ISRG, Netflix still down about 2%. They're up 7% after hours right now. Price to sales of 20 on that one. PE of 66. You are paying a little hefty amount for 14% growth. This is a healthcare company at the end of the day. So it is an interesting kind of thesis on if Trump gets elected and he repeals Obamacare, kind of what is the implications for companies in this med tech supply chain ecosystem? What does it mean for private healthcare? Do their costs go up? Do they get more premiums and subsidies from the government, from Medicare, et cetera? So healthcare companies also in question, when we get a Trump presidency, if we get a Trump presidency, or if we get a Biden presidency in terms of how that's going to play out for their bottom line. So that is going to be interesting. Eli Lilly went down today. Eli Lilly. Wow. Why did Eli Lilly fall 6%? I didn't see that one. I didn't look at this all day. I did not see Eli Lilly all day. Let's see some news on Lilly. That could also just, I mean, that was up like 50% year to date. So I would imagine that could be algorithmic as well. That was because of the Ozempic thing that June told us about in the chat, right? Yeah. New competition in weight loss drugs, right? That is true. That could be from the Ozempic issue as well. So I would imagine NVO, Novo Nordisk, is also down. Yeah, that's down 4%. Yeah, both of them got hit. Yeah, the Roche pill. ISRG has a balance sheet of Palantir. How much cash do they have? I'm assuming you mean they have no debt and they only have cash. What do you think of Amazon and Nike? Both opportunities. Okay, so one piece of news of Amazon. I don't know if they're necessarily opportunities per se. I do think Amazon ends the year closer to like 220 versus where it's at right now. Nike, I'm not fully convinced that it's going to really rebuild the brand yet, but I do think it is getting oversold. Amazon Prime numbers are out, and the numbers we got on Amazon, it's the highest numbers they've ever had. The actual numbers are, if I can pull it up, $14.2 billion, up 10% year over year on Amazon. 14.2 billion on Amazon in 2 days. For context, Amazon does about, I think, 148 billion in revenue a quarter. So that's, 9% of their, basically 10%, 9.8% of their revenue in 2 days was generated this quarter. I mean, it's pretty incredible. I mean, the street knew this was going to happen, so I'm assuming the street, priced it in that it was going to be a stronger Prime Day. But if the margin, what doesn't matter is the revenue. If the margin on that 14.2 billion is just better than it was last quarter and definitely better than it was a year ago, I think the street's going to be happy. And hopefully Bezos doesn't sell as soon as, the street gives it some love. That'll really help it. But right now, street definitely not reacting super positive on that yet. AWS sales, are they going to still be good? AWS is running on 100 billion TTM run rate. I think it's going to crush. I don't think cloud spend is going down at all for GCP, AWS, or Azure. So I expect AWS to do fine. Also, Jeffries put out a report the other day that Twitch, which we forget Amazon owns, is their $46 billion, they called it gem. So they said people are undervaluing the potential of Twitch. Twitch has really never been that exciting because it doesn't really make that much money. A lot of it is, losing money for Amazon, but they're trying to build an ads business that's really exciting for Twitch. They haven't done that for the past couple of years. But that is an asset that's similar to YouTube. Now, it's not YouTube, but it is, somewhat similar from a content perspective. And if they really turn it into YouTube, maybe we can get some more value being priced in from Twitch on the stock. Okay, cool. Let's get some more coverage on Netflix, and then we'll keep going from there. The call will be in about 20 minutes as well. And as William says in the chat, we're all rooting for you, Jared. Jared, this whole chat is praying for you. You got this. You are a stock picking rock star as well. I love it. Here we go.
Content chairman and co-CEO Ben Silverman. He was also formerly co-chairman of NBC Entertainment and executive producer of The Office. Propagate Content will release also a movie titled Incoming on Netflix in August. It's great to have you on, Ben. And what I love about having you on the heels of Netflix earnings is that you can inject some insight into the content piece of this puzzle, which we know is an area where so much spending has happened in recent years. When you look at Netflix and what's been doing particularly well, it isn't just their original content, it's also their licensed content too. So how does it speak to the picture we're seeing and the spending landscape?
Well, I think we had a big retrenchment. We obviously had a strike, which actually delivered a lot of bottom line positive results for many of these big companies. But I think watching what's going on with the Paramount sale that'll hopefully conclude with David Ellison and Skydance is going to be really great for the content market in general, because we've had a couple of the traditional players sitting on the sidelines really cutting way too much in my mind, because they're going to need original content to compete. And then you have other players, specifically Apple and Amazon and Disney, who are in multiple businesses that their content drives, right? The content of the services business inside Apple drives so much other business for their hardware and other elements of their company, the same way that Amazon's Prime business drives more usage and more purchasing through their storefront. And I think Netflix actually is going to be the really most pure play player in the space, and only has upside in starting to monetize their content through commerce outside of their consumer commerce and growing subscribers, but in building brands off the shows they own. And then licensing has always been part of the television ecosystem. The days of hitting the holy grail of 100 episodes off a broadcast so you could syndicate your shows, which helped me a lot in my life, now have moved into the streaming wars, and the content acquisition of licensed content like Suits, like The Office, like Friends, has really driven up new opportunities for rights holders and studios that own those. But you need original content to keep the customer happy.
Okay. How does live programming and sports factor into this as Netflix begins to dip its toe into that realm?
Well, I think, Netflix is starting to look a lot like TV, right? They're starting to look like TV in general. They've got kids programming, they've got foreign language programming, they've got young adult programming, they've got dramas, comedies, and now the next piece of that obviously is live sports and live events. And I think they've dipped their toe in it, and now we're going further as they invest in the NFL and other potential sports franchises down the road.
So here's the question on Netflix, given he's bringing up this whole sports and live event stuff. Do you guys actually think people will watch live sports and or events like that roast of Tom Brady thing on Netflix? Will they do that? Will they actually be able to do that? Netflix Q2 EPS 488, revenue 9.6 billion. Because if they can penetrate that, maybe there is a broader sector of growth. But like Netflix is going to have to bid with the TNTs of the world, the ESPNs of the world to get the rights, the Amazon Primes of the world. And again, as the guy just said, a lot of those companies use streaming as a loss leader to just get you into the ecosystem, like YouTube and like Amazon. So they don't really need the money from that. But if they keep you engaged, then that's what matters. Netflix really needs the money, which is why their revenue is not matching up from the subscribers because people are not paying that much. So I think that's important. They watch NFL on Prime. Yeah. So if they watch NFL on Prime, it's not that people aren't willing to watch on Netflix. I guess the question is, can Netflix outbid Prime, right? Can they actually get to the point where they're competing with Amazon? And I mean, that's just really hard, right? Because it's Amazon on being able to get the analysis that they need. So it'll be interesting to see how that plays out. But right now, Netflix still down after the bell. I do think the live stuff will make a difference. Also, they are building a theme park. We know that they're building a theme park down 1.64%, so coming up a little bit right now. And that theme park, I would imagine, is a tailwind for them. But the operating expenses on that, like you have to build out the theme park. There's going to be money there, and so that's like not going to be free margin the same way some of the subscriber revenue or advertising revenue would be for Netflix. We got Dan Ives just came out talking about his $50 price target. We got the Netflix call in about 10 minutes. Let's listen to Dan Ives here explain why Palantir is $50. Here we go.
The AI revolution's here. And when I look at the next step, the use cases, Palantir, I think, is going to really be the one that's front and center in a lot of these deals. And we're seeing that through a lot of these cloud channels, a lot of the work we do in boot camps. Investors, look, if you've seen, they're negative at 6, they hate it at 12, despise it at 18, and screaming at 25. And I think that this is a stock that has a massive move ahead of it, given where the AI revolution is heading. That's why it's the Messi of AI.
I was curious, Dan, reading your note, what had changed or what different information that you had to take you to that bull case? Because it looks similar to the case that you had made before for the stock. So was there more data that you were gathering to get you to 50 here?
Okay, this question, I really want to know his answer here because everything he said is not really that different from the $35 price target. So I'm interested, why did he increase the price by another $15?
Yeah, Julie, it's just in the almost 100 customers that we've spoke with, the conviction level is increasing. I think deals accelerating. And I think what we're seeing on AIP conversion is even stronger than we expected. Now, does that mean for this quarter, for next quarter? But when I look out the next 6-12 months on Palantir, I think this is going to be a golden child of AI. And right now, I mean, institutionally speaking, it's very negative because I think many don't understand or appreciate the true, what I view as the competitive moat that Karp and Palantir built.
So his argument for why he increased by $15 is that talking to customers makes him believe the use cases are increasing and that should create broader deal conversion. Now, again, that might not happen in Q2. It might not happen in Q3 where the deal conversion is so astronomical where a $50, like realistic, if you put in real assumptions, et cetera, it would make sense. But his argument is it's going to make sense inevitably. And so I think he's doing this early call right now to try to get ahead of what he thinks is the AI monetization cycle coming to software companies.
What, it was interesting, Dan. I was talking not too long ago with Brent Till over at Jefferies and covers Palantir, and he was encouraged by what he saw in Palantir's business and fundamentals, but he was staying on the sidelines, and it was a valuation call. He just thought it looked pricey, but you don't share those concerns here.
Josh, I get the valuation argument, but it's very similar to how I viewed Microsoft and Apple and Tesla and so many other names, that you have to view it as a sum of the parts. You got to view it on what's the commercial business worth, what is AIP going to drive, and then put some multiple on the government business. And I think when you start to put those together, you could start, 35 is our base case, but then you start to get to a bull case $50 into next year as this goes to the second, third, fourth derivative. And I don't know how you could have a basket of AI stocks and just dismiss Palantir. That's sort of our view, and that's been our conversations with investors, even though it's a very contentious name.
So it is just, I'm smiling right now because it is so cool. We got the Netflix call in 10 minutes. It is so cool to see Dan Ives, who's obviously very respected in like the corporate media world, to be advocating for this name. Whether you agree with him or not, or agree with his logic, by the way, I thought that answer he gave was just, it is 1000% correct. You put a multiple on the government, you put it the sum of the parts valuation. I agree with Douglas as well in the chat that it might not happen right now, but when it does happen, it'll be too late to buy in. This is what happens with some of these growthier names that are just more exciting. It is so cool to see Dan really advocate for us, because this is reminding me of what he did in 2018 with Tesla, right? I wasn't, a shareholder at the time, but when I watched those old clips, it's just like, wow, when no one believed, he was there and he said he saw something, even if you could argue even then Tesla was quote unquote overvalued, but he felt there was something coming. And will it come? That's up to Karp, right? That's really up to Karp and execution. But Dan Ives is giving him the benefit of the doubt here and thinking that phenomenal leadership will be able to execute.
Dan, I'm sure you're aware of some of the chatter, you kind of referred to it, that's out there lately. There is some skepticism creeping out there on AI. Edison Lee over at Jefferies just writing today that what we're seeing right now in tech in terms of sell-off isn't actually about geopolitics. It's not actually about concern over China and Taiwan. It's actually about concern over AI's return on investment. I know you don't agree with that, clearly. But, are people, what do you think that's about? Is it just that people are getting impatient here? What do you think? Or do you think that they have a point?
Look, this sell-off, I can tell you from all my conversations the last 48 hours, it's the Trump, Taiwan, China war, right? Those comments, and obviously he'll speak tonight, and then you factor in what potential Trump second term, what does that mean in terms of the AI trade? So I think that's this sell-off. But Julie, I think when me and Josh talk in the next few weeks, and Josh is wearing his pink sports jacket, I think we're going to have a massive tech earnings season for tech, for semis, for software that changes the narrative. But I always say, you can see AI on your spreadsheets or in the 10th floor of your New York City office building. And I think that's why we spend so much time around the globe, and there is no denying this AI revolution is probably the biggest tech trend we've seen in the last 40, 50 years.
Switching gears here, Dan, another name you cover. I want to get your take on Apple, because we did have, well-known analyst Ming-Chi Kuo was writing today that there's been these rumors of increased orders for iPhone 16 from time to time. But looking at recent earnings calls from some Apple suppliers saying, hinting that the iPhone 16 orders may not have increased. Where are you on Apple as we head into that earnings print as well, Dan?
Yeah, Josh, many yell fire in the crowd theater on Apple. 160, 170.
Okay, if I'm Dan Ives here, I'm definitely going to gloat a little bit, dude, because he was the only guy I knew on the street that said at 160 it was a buy. So I'm going to take my victory lap here if I'm Dan Ives.
So I get it. At 230, people are going to double down those calls. All of our checks show rising demand for iPhone 16. The AI story is coming to Cupertino. I think a lot of investors have been caught off sides on this one. And I think a year from now, we have a $4 trillion market cap. But again, I get the skepticism. A lot of haters in Apple at 150, 160. And at 230, they really hate it.
So overall, his analysis on Palantir, if I had to sum it up, his argument is, hey, some of the parts valuation, we've got a lot of different elements going on to the stock. Number two, you got to put a multiple on the government, which I think Mizuho, Jefferies, Morgan Stanley, none of them care about the government business, which is ridiculous. And I don't understand how you can ignore a business doing $1.5 billion a year, but they ignore it. Mariana and Dan Ives are the only analysts that actually care about it. And then the third part of the thesis for increasing the price target is AI monetization is here. And I think the last sentence he said is also really important. You can't have a discussion around AI companies, AI stocks, without mentioning Palantir. And if you mention Palantir, and you know, as investors were mentioning it, obviously customers are mentioning what does it mean to use AI in their enterprise. And then you just have an exceptional leader like Karp who's getting things done. The Daily Palantir episode that's going to come out later today will go in depth on the Bavaria police partnership that we got in Germany. That to me is just the beginning of the momentum in international acceleration. It's a small contract, 5 million euros. I know it's not like the NHS contract, but it's the thesis that Karp had that they're going to come back to us because they can't do it themselves because the software is just too good. And I think Dan Ives is also going out on a limb here and saying, well, if that's the case, then a lot of companies, much less governments, are going to come to them in the future. And I think it'll be $50 by then because the growth will be priced in and the valuation will make more sense as the growth ends up coming there. This is the fun part about being an investor, right? We don't know. It's easy to invest in Google right now. That story played out. They won. It's easy. You know, whether it goes up or down from here is whatever, but like it played out. Palantir, the story is not even, I don't even think begun. I mean, the story is really, it's sub 100 billion. We are just getting started. And so maybe we're all wrong. Maybe the thing crashes and burns, but that's the fun thing about being an investor and taking a bit of a risk is like, if you're right, you're really right. If you're wrong, you're wrong. But I think Dan Ives is correct, at least as an analysis. Now, in terms of valuation, we got Netflix Call in 4 minutes. I know a lot of people are annoyed that Dan Ives doesn't care too much about valuation, and $50 means $120 billion market cap. That sounds ridiculous for a company doing less than $3 billion in revenue. I get it. I think Dan's argument is like, hey, he's not a valuation guy. So when he thinks of like how to put a price target on a stock, it's more so a question of what are the things you put a multiple on? And then are those things going to grow and be even bigger than what investors think? That's how he's valuing FSD. That's what he obviously did for Apple when it was at 160 and people thought Apple was still expensive, which by the way, it was at 160 in my opinion as well. So it's very expensive at 230 in my opinion. But if you see this whole upgrade cycle going on, then it's not expensive. Then it's actually going to grow into that valuation. And I know that sounds like something everyone says, but it is what it is when it comes to these growth stocks. And that's what I think he thinks Palantir is going to be able to do. At Apple, I was waiting for 150. I was like, guys, if it gets to 150, I'm going to buy. It's like it stopped at 167 and then boom, it's gone, right? And I think that could happen with Palantir for those that are waiting for like 19, 18, 14. It's like, dude, it's going to be tough to get there. I think low 20s is possible again, but below that, I think it's not going to be the easiest to get there right now. So we will see. We will see what happens from there. All right, so we got this Netflix call in 3 minutes, and we will see what Ted Sarandos has to say about the company's performance. Netflix right here down about 1%. NVIDIA up a little bit. Palantir up a little bit as well, 28.77. Again, if you missed the morning open stream, we cracked above 29.83. I got a bunch of text messages after that stream of people that were just like, oh my God, we got to 29. We got close to 30. We were 17 cents away from 30. It would have been cool to see 30 today, but I also think the day we see 30 is going to be the day we deserve to see 30, meaning it's after like a big earnings beat or it's after like, some type of event, some big contract. So I don't know. It's kind of okay that we didn't see 30 today because today was just a random day. But when we do see it, I think it'll be a fun day. And it'll be exciting to see when it plays out. CrowdStrike got upgraded. Someone said I'm waiting for Crowd to drop more. I don't blame you. I think CrowdStrike is very richly valued. 343 right now. They got upgraded to 450, I think, at Oppenheimer. If Google is buying Wiz for 23 billion, which is another cybersecurity name, CrowdStrike at 83 billion, which does Wiz is doing 450 ARR. CrowdStrike's doing like 2 billion. So, I mean, Google's paying a hefty premium, but it's likely because this sector seems to be more important than ever. We're seeing with the Snowflake data breach, et cetera, the Disney data breach yesterday. So cybersecurity seems to be a growing sector. And it seems like CrowdStrike is the number one pick for a lot of the Wall Street firms that are interested in that. Snowflake, how did Snowflake do today? Snowflake is down 3.89% today. Wow, back below 130. Goldman Sachs did lower their price. Not Goldman Sachs. I'm forgetting the name. Goldman Sachs is a $220 price target. Another firm today came out and they said they're lowering it to 180, but they do believe Snowflake will outperform in Q2 because it's got oversold. But their price target on Snowflake now is $180. ISRG is up 6%. That is correct. I learned about that stock for the first time today. ISRG up 6.5% after hours. All right, we got about a minute, and then we will have Netflix. After Netflix earnings, I am going to New York City, and I'll be meeting Chris today for some sushi dinner. So I'll definitely post some photos of that on Twitter. I'll ask Chris what it feels like to get out of your put position early in the morning when Dan Ives basically demolishes any chance that you had. And maybe Chris would have been right on that put position, but he was just like, I need to sleep. I need to sleep at night without worrying about the Palantards ruining my day. So he lost like $500 on it, which was funny. So we're gonna me and Adam will give him some shit on that. That'll be funny. Domino's got crushed today. Yeah, I'm gonna go through Domino's report tonight. I'm gonna see what's wrong. Why aren't people eating pizza? Because that is concerning. People should be eating pizza in America. We're Americans. What's your favorite fish? I just thought of a joke. I'm not going to say the joke because I'm not going to say the joke. But my favorite fish, my favorite sushi is shrimp tempura. Shrimp tempura. That is my favorite. So I'm looking for some high class sushi today. Like I want good sushi. If we're going to go out, I want like, I don't know how much we're going to spend, but probably like four of us probably going to spend like $100 each on sushi. So I want some good sushi and hopefully it's good. I also like eel avocado. Eel avocado is great. So I like that as well. I'm not going to say what joke I was going to say. Some of you got it in the chat. I'm not going to say it, but there's definitely a joke I was thinking about today. Chris is feeling like Domino's today. He only lost $500, so he doesn't care. But overall, it was cool. All right, Netflix earnings. Here we go.
Earnings interview. I'm Spencer Wong, VP of Finance, IR, and Corporate Development. Joining me today are co-CEOs Ted Sarandos and Greg Peters and CFO Spence Newman. As a reminder, we'll be making forward-looking statements and actual results may vary. We'll now take questions from the sell-side community that have been submitted, and we'll begin with a set of questions on our Q2 results and our forecast. So the first question on our results come from Doug Anmuth of JP Morgan. So Spence, Doug asks, can you provide some color on how churn is trending and perhaps share some color on what drove revenue growth in the quarter?
Yeah, sure. Well, thanks, Doug, and thanks, Spencer. We're pleased with our performance in Q2. There was strong performance across the board, good momentum across the business, strong revenue growth, member growth, and profit growth. In terms of that member growth and churn, I'd say that the kind of outsized paid net adds in the quarter was primarily driven by stronger acquisition, a little stronger than we expected, but also very continued healthy retention in the quarter, and that's across all regions. In terms of growth generally, there's probably kind of three key factors that drove member growth. First, strong performance of our content slate, the wide variety of titles that delivered across genres and regions, and I'm sure we'll talk more about that. There was some positive impact from paid sharing that continues. As we've said on recent calls, it's tougher and tougher to tease that out. We're clearly seeing healthy organic growth in the business, but we're also continuing to get better and better at it, translating improvements in our service into business value, including getting better and better at converting unpaid accounts. And at least on the paid member front, we're also probably benefiting from that attractive entry point in terms of price point and feature set for our ads plan. So you put all that together and it was a nice quarter for subscriber growth, but even more importantly, a nice quarter in terms of driving healthy revenue growth and healthy profit growth. So 17% reported revenue growth and margins that were up 5 percentage points year over year.
Thanks, Spence. Doug also has a follow-up question on the results. We noted, or Netflix noted, that India was our number 2, number 3 country in terms of paid net ads and percent revenue growth in the second quarter. Do you feel like you're hitting more of an inflection point in that market, or is that more about a very specific successful content slate in Q2?
Ed, do you want to take it or?
Yeah, well, look, I think India's growth is a story that we see around the world playing out very similarly. So you look at the content, the product market fit is what drives our ability to attract members and retain members and monetize with them as well. So I feel like what's going on in the quarter has been this ongoing build. We had this great show, Hera Monday. Sanjay Leela Bansali, SLB, is one of the most celebrated filmmakers in India, and he took on this incredibly ambitious series and brought it to screen on Netflix, directed every episode, and it's our biggest drama series to date in India. So on top of that, our original films and our licensed films as films in the pay TV window, they're immediately following theatrical, have continue to thrill our members. So if we pick them well, we program well, we improve the product market fit, we improve engagement, we grow members, we grow revenue. It's the same formula, I think, everywhere we go. And there's certainly plenty of room to grow in India as long as we keep thrilling our audiences there.
Thank you, Ted. Our next question on the results relate to operating margin, and the question comes from Jessica Reif Ehrlich of Bank of America. For Spence, how should we think about the pace of margin expansion going forward and the drivers of the margin outperformance this year?
Thanks, Jessica. Well, when we think about margin expansion, we're obviously pleased with how it's trending so far. Our focus, kind of stepping back, our focus is to sustain healthy revenue growth and grow margins each year. So we feel good about what we've been delivering. As you see in the letter, we're now targeting 26% full year operating income margin. And that's up from our prior guide of 25%, and it's up 5 percentage points year over year, assuming we kind of land there. But the amount of annual margin expansion, as we look forward, it could bounce around each year. And we've talked about this in recent quarters. It could bounce around because of foreign exchange in a year where that moves, or other business considerations. But we're committed to grow margins each year. And we see a lot of room to continue to grow profit margin, absolute profit dollars, and do that over an extended period of time for years to come.
Thank you, Spence. Our next question comes from Stephen Cahall from Wells Fargo, and it's regarding free cash flow. So the question is, Netflix has raised their full year revenue and margin outlook, but did not change their free cash flow forecast of approximately $6 billion. Is this just a pull forward in cash content spend, or is there anything else that is impacting your free cash flow guidance?
I'll take that one. Nothing else impacting it. We, as you noted, we continue to expect approximately $6 billion of free cash flow for the year. There's always some uncertainty in terms of timing of things like content spend, sometimes timing of taxes. So that kind of keeps us right now holding at approximately $6 billion, but no other read through beyond that.
Thank you, Spence. We have our quarterly question on paid sharing next from John Hoodlick of UBS, which I'll direct to Greg. The question is, do you still have upside from the paid sharing initiative? And have you moved forward on mobile paid sharing? And if so, how big of an opportunity is this?
Yeah, Spence already gave some commentary on this quarter's performance. I'll talk about it sort of from a long-term perspective. And as we said, for a couple quarters now, we're at the point where we really operationalize pay sharing. So it's just a standard part of our product experience. And we think about the improvements there. And to be clear, we do see still some significant areas for improvement there. But we see those as part of all the opportunities essentially we have to improve the product experience. So we're constantly prioritizing all those opportunities based on what we think is the expected value. And just to give you a sense of how wide that is, even things that we've been working on for over a decade, like our sign-up flows, or the user experience that a consumer has when they want to sign up for Netflix, we have found multiple improvements just over the last couple of quarters in those flows, which have delivered material incremental revenue wins. So we're going to continue to look at all these opportunities. We're going to improve things for members and for the business. We'll iterate, we'll improve them. And we think of this as just a constantly improving value translation mechanism. So we want to take all the value that's created by Bella's teams in film and series. We got more live events, games, and we want to translate that more effectively into revenue so we can continue to invest and keep that flywheel spinning. And if we can keep improving that value translation mechanism each quarter and keep improving the entertainment offering that it operates on top of, those two things compound and drive the business. It'll drive the business through the rest of the year. It'll drive through 25 and beyond. And that really allows us to more effectively get more of those 500 million plus and growing smart TV households around the world that aren't currently members to sign up. And it also drives our other levers of growth, like plan optimization, extra member, ads revenues, and pricing into more value. So I I think about this as more of the constant work we are doing to improve for decades to come.
Thank you, Greg. I'll now move us along to a series of questions about advertising. And we'll start first with Barton Crockett of Rosenblatt. And I'll point this question to Spence. You say that advertising is not a quote, primary, unquote, driver of revenue growth yet. Can you provide a little more clarity on what that means for both 24 and 25?
Yeah, sure. Thanks. Stepping back, I'd say we're very pleased with how we're scaling our ads business. We talk about that in our letter. We've been primarily focused on scaling reach. But if you think about even just the revenue portion of ads, it is growing nicely. The rate of growth, it just happens to be growing off of a relatively small base because we're starting from only 18 months into ads. So to have the kind of a primary revenue impact across a business that has been primarily subscription for a long time, that just takes some time. So we're scaling well through reach, through engagement, through growing inventory, and that represents opportunity for us over a multi-year trajectory to have a big and increasing revenue and profit impact on the business. So again, stepping back, we feel really good about our position, our ability to sustain healthy revenue and profit growth. Ads is kind of one more tool in our tool chest there, and we're doing the hard work now to improve our service across the board. So we finish the year strong in 24 and drive growth into 25 and beyond. We're small in every measure. We talk about it a lot. We're small in share of TV time. We're small in terms of penetration of connected TV homes. We're small in revenue market share. And we're going to grow in those areas across the board. And ads is going to be a bigger piece of that puzzle. We won't have it be primary in 24 or 25, but it contributes. It's a meaningful contributor. That's what we've said, and that's what it is doing. And then when you get into 26 and beyond, it can be even more meaningful and hopefully becomes the point where it is a primary contributor, given all of that engagement and reach that we're building.
Thank you, Spence. A follow-up question on advertising comes from Ben Swinburne of Morgan Stanley, and I will direct this to Greg. Looking into your advertising revenue ramp into 2025, what are the key areas that need to improve to bring in significantly more revenue? Can you talk about the opportunities and challenges scaling up your direct sales efforts and leveraging third-party sources of demand, primarily programmatically?
Yeah, we've said many times our priority, number one priority, first priority is scale. So we've been heavily focused on that. And the great news is we've seen great progress in that regard. We've been scaling our ads member base very quickly from 0 2 years ago to where we are today. And we're excited to say that we're on track to achieve our critical scale goals for all of our ads countries in 2025. Clearly, we expect further growth beyond that, but that represents a great threshold to get to and then to build more scale and more attractiveness from there. So that allows us to shift more of our energy now on more effectively monetizing that rapidly growing inventory. And there's sort of two main fronts here. One is our go-to-market capability. So we're adding more sales folks, we're adding more ads operation folks, building our capabilities to meet advertisers. A big component of that is giving advertisers more effective ways to buy Netflix. It's a big point of feedback that we heard from advertisers. So by adding demand sources that are already integrated into their processes and their systems, that just makes it easy for them to buy. And in some cases, that was a threshold item for them to buy in us. So we're going to expand the number of buyers as a result of that. And then the other big area of growth for us is the sort of product and technology stack. We mentioned we're building our own ad server now. We're excited to launch that in Canada this year and then the rest of our ads markets in 25. That unlocks a whole set of innovations that we expect that are focused on a better user experience for our members on those ad tiers and better advertiser features. So think a lot about this as targeting, relevance, more capabilities in that space, as well as thinking about, how do we do ROI, ROAS, incrementality measurements, all the things that we want. And ultimately, really, this is about bringing what has been amazing about digital advertising in terms of targeting, relevance, measurement, et cetera, and what we think is amazing about TV advertising, which is an incredible creative format, better creative format in many cases than digital, as well as the ability to put those advertisements next to content, to titles, stories that are, impacting the social conversation, which is important for advertisers. So lots of work ahead. We've got years of work to do, but that's the line that we're moving forward with.
Thank you, Greg. From Stephen Cahill, his question is, given what we think are pressures on AVOD CPMs and the 10 hours per account per month of viewing time you disclosed at the upfront for ad-supported members, what's the likelihood that ad-supported ARM drops below ad-free member ARM in the second half? Would you consider raising the price of ad-supported tiers as an offset?
Okay, so perhaps starting by just providing some clarification here. Our engagement on our ads plans is very similar to what we see on our non-ads plans. That's close to the approximately 2 hours of viewing per member per day across all the plans that you can calculate globally from our engagement reports. You should think of that as roughly, how our ads plan members are engaging as well. And then on terms of ads ARM, so ads ARM, which is of course the combination of the subscription amount plus the ads revenue. Currently, because we've been scaling so rapidly, we're racing behind essentially to fulfill all of that increasing inventory, and we're lagging in that regard. So currently our ads ARM is lower than our non-ads ARM. And that's obviously, we look at that as both, it's a go-do, but it's a revenue growth opportunity for us as we scale into that. That represents an opportunity to accelerate our revenue growth as well. So you mentioned price. We think about pricing for our ads tier very similarly to how we would think about pricing for our non-ads tier. First of all, I just think it's worth noting that we love having an entry price that's lower. That means we are more accessible for more people in our ads markets. That's a great thing because they get access to all the amazing storytelling that we are doing there. But in terms of raising that price, we think about it similar to how we think about pricing in general, which is it's our job to increase the value that we are delivering all of our members. We've got more amazing film, more series, the live events that are coming, more games. And when we have signals from our members, this is the amount of acquisition that we've got going on, engagement, what our retention and churn looks like. Then we find the right moment to ask our members to pay a bit more to keep that flywheel spinning. And we'll think about that in the ads context, just like we would in the non-ads context.
Thank you, Greg. John Hoodlick from UBS asks, can you provide an update on the CTV ad environment and update us on initial feedback from advertisers on your ad tech initiative? What features do you expect to add with the ad tech build, and anything you can tell us about the costs associated with it?
Sure. There's a lot of excitement amongst advertisers about the work that we're doing. I'd say that the primary one, and again, one that we're responding to, which is sort of very tactical and immediate, is being able to provide advertisers more ways to buy on Netflix. So those demand sources is something we heard very clearly from advertisers that it was either a real improvement for them, or it was a necessary point for them to be able to buy on Netflix. So then beyond that, we hear lots of enthusiasm for the things I mentioned before: increasing ads relevancy, targeting personalization, better measurement, incrementality, all these things that we'll be building over the next several years. Lots of excitement about that. The biggest negative feedback we get is that we aren't there right now. So advertisers want us to have all those features in place today. We would love to have all of those features in place today for sure. So we're got the hard work ahead of us of building those as quickly as we possibly can and closing that gap as soon as we can. But this is it's years ahead of us to go ahead and keep building these things. And quite frankly, as we build those features, I'm quite certain that there'll be more that will come onto the roster that advertisers will be asking for us, and more that we'll be excited about doing.
Thank you, Greg. And our next question is for Ted, coming from Rich Greenfield of Lightshed.
Hey, Spencer. Spencer,
Yes.
Sorry to interrupt you. We didn't really answer the kind of cost thing, unless I missed it. Did I miss it in terms? So I can chime in if you like. All of what Greg talked about in terms of investing in the business, suffice to say that is all embedded in our margin guidance. So we make trade-offs all the time with the business. Our expenses are up 7% year to date. Where if you kind of step back, we're on track to be. You can do the math. It's probably north of $28 billion in total expenses across our business for the year, and we're still expecting to deliver 5 percentage points of margin improvement. So we try to run the business like owners, make smart trade-offs, and invest into growth like live, like ads, like games, like product innovation, and ads is part of that, both for this year as well as into next year, where again, we expect to drive revenue growth and increase our margins while investing into ads.
Thanks for catching that, Spence. Yeah.
Yes. Thanks for keeping us honest, Spence. Next question is for Ted, coming from Rich Greenfield of Lightshed Partners. Is your recent agreement to stream 2 NFL games on Christmas Day signaling that you need live sports to build a robust advertising business? Or are you trying to create a regular cadence of high-profile live events to bring advertisers onto the Netflix platform, who will then spend across your broad array of entertainment content?
Thank you, Rich. It's a great question. And let me back up a minute. We're in live because our members love it. And it drives a ton of engagement and it drives a ton of excitement. And those two things are very valuable. So the good thing is that advertisers like that too, and they like it for the exact same reason, the excitement and the engagement. So everyone's interests here are perfectly aligned in that way. What we signaled to the world when we went live with the Chris Rock Selective Outrage special last year ago is that this company, Netflix, who you love for on-demand viewing of your favorite TV shows and movies, is also, I say also, going to surprise you with amazing, exclusive, buzzy live entertainment. And since then, we've launched a golf tournament with the biggest stars in PGA golf and Formula One drivers, a tennis match with 2 like generational titans of professional tennis, Nadal and Alcaraz, a live comedy with Cat Williams, an entire week of groundbreaking live talk show episodes from John Mulaney, that epic roast from Tom Brady, our biggest live streamed yet. And still to come, we've got a live show with Joe Rogan. We have this hot dog eating grudge match between Chestnut and Kobayashi that people are remarkably excited about. We have this long awaited boxing match between Mike Tyson and Jake Paul in November. And on Christmas Day, not just 1, but 2 great NFL football games. So I would call that a really fast ramp, and it leads right into weekly live coverage of WWE. So it's that thrilling, excitement, engaged watching that people are really thrilled about, and we're thrilled about, and that we're thrilled that our advertisers are excited about it too.
Thank you, Ted. Rich has a part 2 to this question, not surprisingly. How do you thread the needle on licensing sports to drive advertising spend without becoming beholden to leagues at renewal?
Well, hopefully exactly the way we're doing it, by making these Netflix events, not necessarily taking on a lot of tonnage from any one league, but actually making these games events, like having 2 NFL football games on Christmas Day, and 2 great games, the Chiefs and the Steelers and the Ravens and the Texans. They're both going to be great games. And it's creates a lot of real excitement with the service. And it's 1 day of football. So when I look at that, and I think along those lines, you'd see how we solved for that in our WWE deal, which was economics that we like and live with and can grow into and contemplate what that expansion of cost and viewing would be over in that case, as long as 20 years if we want it to be. So I think it's really not a matter of there's an automatic disconnect between you can't do sports and have profit. It's very difficult to have big league sports and profit, when you offer them entire seasons. But when you offer them in this event model that we're building on, we're really excited about our opportunity to do that without the risk that you're talking about right now. So, and then beyond that, we're in love with the kind of very profitable storytelling version of sports. So if you can't wait for those football games on Christmas Day, you can watch Receiver right now. It just started on July 10th on Netflix, which is part of that storytelling version of sports.
Thank you. Thank you, Ted. Our next question comes from Kanan Venkateshwar of Barclays. It's a question regarding our engagement. So, Ted, could you speak to the underlying engagement health at Netflix, and what are you seeing there?
Yeah, look, I think I talked about this a bit on the last call as well, but competition for entertainment is super intense, and we compete for every second of view time we get. So beyond that, kind of the competitive intensity that's always been out there, we also anticipated some headwinds in our engagement because of paid sharing. Remember, we were taking folks who were watching Netflix and not paying off the service. So we thought that our engagement would go down. We took a deep dive into how that was impacting and how we could isolate the impact and look at it as owner households. So those folks who were not impacted by paid sharing at all, And what we saw was in last quarter is that engagement was holding steady, so that much of the engagement headwind was coming from that. But now we look forward a quarter. Now, I'm not going to get in the habit of releasing this as a new metric every quarter, but looking at that same segment again, that segment's engagement is actually not just steady, but up year on year. So we're very excited about that. I think it's a very healthy sign of engagement growth. And even with all of that, so beating down the headwinds of that and beating down competition, we're still about 10% of TV time in every country we operate in. So still lots of room to grow, but very pleased with our engagement, but not fully satisfied.
Thank you, Ted. Our next question comes from Ben Swinburne of Morgan Stanley. Your primary competitor for more passive home entertainment engagement increasingly looks to be YouTube. What are you doing in terms of programming and product to try and take share from YouTube in the future, or is this not a focus? Are there key verticals like kids programming where you see YouTube as particularly advantaged? Perhaps Ted, you and Greg can tag team on this one.
Yeah, sure. Looking at the Nielsen data that just released for June, what you see there is Netflix and YouTube are the clear leaders in direct-to-consumer entertainment. So our two us and YouTube represent about 50% of all streaming to the TV in the US. And we use the US only because that's where we have the data. So really what we're focused on here is focusing ourselves on that other 80% of total TV time that isn't going to either us or YouTube. So that's a ton, that's both streaming continuing to expand, which it did in June. So that share of TV time grew against linear. And as linear continues to give, I think there's a lot of opportunity for us to grow as long as we keep executing well. Now, we clearly do compete with YouTube in certain segments of their business, and we certainly compete with them for time and attention. But our services also feed each other really well. So remember, our shows are the most watched and talked about and award nominated. We just came out of 107 Emmy nominations for our slate this year, yesterday. And so our teasers and trailers and behind the scenes clips and all those kind of things are incredibly popular on YouTube. So in that way, we kind of feed each other pretty nicely. Greg, I don't know if you want to add anything.
Sure. I think it's also important to note that Netflix fulfills an important and differentiated need for both consumers who really want, they want amazing spectacle movies and TV shows, as well as an important need for creators who want partners that can share in the risk that's inherent in bringing those stories to life. So you think about, shows like Stranger Things or Wednesday, Heartstopper, Outer Banks. These shows create amazing human fandom, and especially with younger audiences. So it's not, just one generation. And it's really hard to imagine how that kind of big creative bet would happen and be possible within YouTube's model. So, to Ted's point, it is very competitive out there. And we also feel confident that our model works. It works well for our consumers, it works well for creators, and it works well for our business and helps us generate significant operating margin.
Thank you, Ted and Greg. Our next question comes from Maria Rips of Canaccord. Netflix's CTO, Elizabeth Stone, recently appeared on a podcast where she said that Netflix is exploring how to integrate generative AI into the platform to improve the member experience. Do you think that technology could have more of a potential impact on the content creation or discovery side? How do you think about the relative impact on engagement from improving discovery versus content? Greg, over to you for this one.
Yeah, we've been using similar technologies, AI and ML, for many years to improve the discovery experience and drive more engagement through those improvements. We think that generative AI has, tremendous potential to improve our recommendations and discovery systems even further. We want to make it even easier for people to find an amazing story that's just perfect for them in that moment. But I think it's also worth noting that the key to our success stacks, right? It's quality at all levels. So it's great movies, it's great TV shows, it's great games, it's great live events, and a great and constantly improving recommendation system that helps unlock all of that value for all of those stories.
Yeah, I think it also, it begs the question about, the impact on creative with AI going forward, which is hard to predict, obviously. But I would say this: I think that AI is going to generate a great set of creator tools, a great way for creators to tell better stories. And one thing that's sure, if you look back over 100 years of entertainment, you can see how great technology and great entertainment work hand in hand to build great big businesses. You could look no further than animation. When animation didn't get cheaper. It got better in the move from hand-drawn to CG animation. And more people work in animation today than ever in history. So I'm pretty sure that there's a better business and a bigger business in making content 10% better than it is making it 50% cheaper. So remember, I think that shows and movies, they win with the audience when they connect. And it's in the beauty of the writing, it's in the chemistry of the actors, it's in the plot, the surprise and the plot twist, all those things. And I'm not saying that audiences don't notice all these other things, but I think they largely care mostly about connecting with the storytelling. And I'd say they probably don't care much about budgets and arguably maybe not even about the technology to deliver it. So my point is they're looking to connect. So we have to focus on how to tell on the quality of the storytelling. There's a lot of filmmakers and a lot of producers experimenting with AI today. They're super excited about how useful a tool it can be. And we got to see how that develops before we can make any meaningful predictions of what it means for anybody. But our goal remains unchanged, which is telling great stories.
Thank you, Ted and Greg. We now have a question from Ben Swinburne regarding product. And the question for Greg is, can you dimensionalize the opportunity from a new homepage? You said that this is the biggest update in a decade, which sounds meaningful. What are the primary areas of improvement you're targeting with this?
Yeah, it's hard to know exactly at this moment how much benefit that new homepage will derive. I think it's worth noting that it's less about the improvements that we're going to deliver initially, but it's more about creating a structure that allows us to evolve and advance more freely than the current structure does. And in terms of what are the pain points, what are we trying to solve? A lot of this is getting to the increase in diversity of entertainment that we are now offering. So, we've been amazing at film and series for a long period of time, but now increasingly we're adding live events into it. It's live events like, the Brady Roast, which was incredible, but it's a sort of one-off event that we have to create demand for. It's live events like WWE, which are consistent and repeating, that we want to make sure that fans of that experience have an easy way to access those things. We're increasingly promoting games as well into our service. So what we found is we need to create structures that allow us to flexibly go from one type of content and entertainment to another in terms of how we're promoting and connecting those. So there's things like that. There's also things like we want to increasingly recognize that we're doing, even in the same content type, we're doing different jobs for our users in different moments. And that could be, Sunday afternoon family movie time. That'd be a great experience if we want to provide exactly the right discovery and choosing experience for, versus maybe late on Thursday night when you're coming home and you just want to get into the next episode of the series that you're currently cruising through. So it's that kind of flexibility we want to provide. Our expectation is that this new structure will allow us to deliver, as the old structure did for a decade, multiple repetitive material benefits to users in terms of engagement, which lead into retention and then revenue. But again, that'll be a long iterative journey, and mostly we're trying to take that first step and set us up for that.
And less technical too, Greg. The UI is beautiful.
There we go. We like beauty as well. Beauty is good.
It is. It really is.
Thank you. Next question is from Jason Helfstein of Oppenheimer. What have been the early results from phasing out the basic tier in a handful of your markets, and how does that tie back to success in selling ads? Greg, do you want to take that one?
Sure. As you've seen us do, multiple times before, we spend a lot of energy on the right product experience for doing this migration. And then what we do is we roll it out and we test it and we see how that goes, and let our members tell us if we did a good job there or not. We make whatever changes and iterations before we then scale it out and roll it even further. And I think it's worth noting here that we feel like in this migration, we've got a very strong offering for our members. Essentially, we're providing them a better experience, 2 streams versus 1. We've got higher definition, we've got downloads, and of course, all at a lower price, $6.99 in the United States. We think that represents a tremendous entertainment value, and it includes ads. And for members who don't, want that ads experience, they of course can choose our ads-free standard or premium plans as well. And then in terms of performance, I'll just let our actions speak for ourselves. When those things go well, we typically roll it out, and that's, we've had the confidence to move forward with that change in the US and France. So that's an indicator of how it's going.
Thank you, Greg. Next question comes from Eric Sheridan from Goldman Sachs. The question is regarding gaming. Can you provide any update on your gaming initiative and user engagement and your ability to scale your gaming efforts?
Sure. Games is a big market, so it's almost 150 billion ex China and Russia, and not including ad revenue, which we aren't participating in our current model. And we're getting close to 3 years into our gaming initiative, and we're happy with the progress that we've seen. We've set ourselves pretty aggressive engagement growth targets, and we've met those, exceeded those in many cases. In 2023, we tripled that engagement. We're looking good in our engagement growth in 24, and we've set even more aggressive growth goals for 25 and 26. But worth noting that engagement and that impact on our overall business at the current scale, it's still quite small. And it's also probably worth noting that the investment level in games relative to our overall content spend is also quite small. And we've calibrated the growth in investment with the growth in business impact. So we're being disciplined about how we scale that. So now, obviously, the job is to continue to grow that engagement to the place where it has a material impact on the business. And I think you've seen this trajectory with us before, whether it's been a new content genre like unscripted or film, or maybe getting the content mix right for a particular country. You can think about Japan or India, which we're now in an amazing place through the hard work of our teams there. We continually iterate, we refine our programming based on the signals we get from our members. And if you look over several years with that model, we can make a huge amount of progress. We've launched over 100 games so far. We've seen what works, what doesn't work. We're refining our program to do more of what is working with the 80 plus games that we currently have in development. And one of those things that really is working is connecting our members with games based on specific Netflix IP that they love. And this is an area that we've been able to move in quickly in a particular space, which is interactive narrative games. These are easier to build, and we place those in a narrative hub that we call Netflix Stories. Q2, we launched Virgin River and Perfect Match. Starting this month in July, we're going to launch about one new title per month into Netflix Stories. And this is, amazing IP like Emily in Paris and Selling Sunset. And we have lots more, including very different types of games yet to come in the quarters and years ahead.
Yeah, I just want to chime in for a second, Greg, if you don't mind. This is why I'm really excited about the opportunity in games, which is the way that it's pretty rare for the new content vertical like this to actually complement or draft off of of each other. So every once in a while we get something like Squid Game: The Challenge following the Squid Game, the scripted series. But I think our opportunity here to serve super fandom with games is really fun and remarkable. I think the idea of being able to take a show and give the super fan a place to be in between seasons, and even beyond that, to be able to use the game platform to introduce new characters, to new storylines or new plot twists. You could do those kind of things, and then they can then materialize in the next season or in the sequel to the film. It's a really great opportunity and a rare one where 1 and 1 equals 3 here, and to kind of replicate some of the success we've seen building fandom with live events and consumer products. This actually fits really nicely into that. So I'm really excited to see where this goes.
Thank you, Ted. Thank you, Greg. Our last question comes from Jessica Reif-Ehrlich of Bank of America. The question is regarding content spend. Ted, you have targeted $17 billion in cash content spend this year. You're increasing your sports spending within that. How should we think about your spending on entertainment or non-sports entertainment, and what's the overall content spending growth going forward?
Well, thanks for the question. I would like to just back up a little bit and say that, creating TV and films for a big global audience is a creative process. So remember, we're programming for more than 600 million people around the world who are watching us for a couple hours a day, every day. So we've got our work cut out for us. And that 17 billion, all those exciting things we talked about earlier are all tucked into that 17 billion. And that 17 billion will grow as our revenue grows. It won't grow as fast as our revenue grows, but it will grow to accommodate that. And I think what's really important, and where I think we have a real interesting advantage here, is that we have these distributed creative teams all over the world. So what's great about that is they are very tightly wound into the creative ecosystem in all these different countries, the star systems, the producer systems, and more importantly, the culture, what fans in those countries really love. So we've got all these folks working at the same time so that in this creative process, which does have, hot streaks and cold streaks, they can be operating pretty simultaneously to create a very steady cadence of big, exciting hits. We certainly compete with Hollywood to make the best and most popular programming in the world. But we're also doing that in India, in Spain, in France, in Italy, in Germany, in Korea, in Japan, all over Southeast Asia, in Mexico, in Colombia, Spain, Argentina, and the UK. And the programming that we create in those countries, all part of that 17 bill, are all designed to thrill the local audience. And when they really, really thrill the local audience, there's a possibility and sometimes a probability that they could find a gigantic audience all over the world, including in North America. So the team in EMEA, particularly in the UK, is doing a remarkable job of this right now. So they have been able to deliver big global hits, but they've been sensational in country. So Baby Reindeer and The Gentleman both landed with Emmy nominations yesterday and have been sensations in the US, but they are a phenomenon in the UK. So more than 50% of all of our members in the UK have watched or are watching Baby Reindeer and The Gentleman. Similarly with One Day, our original film Scoop. So those things that are thrilling the world are super serving the British audience. The same thing just came out of Paris, or out of France with Under Paris, which was 90 million views, 157 million view hours around the world. More than half of every French member loves this movie. Same thing with the Asunta case in Spain. More than 50% watching in Spain and big watching all over the world. Queen of Tears in Korea is another example that's happening in APAC right now. So this kind of like super serving local audiences, creating global content around the world gives us an efficiency that I think is getting better and better, and a muscle that's getting stronger and stronger that I'm really excited about. And how does that play out? Our slate coming up is unbelievable. So as we've currently forecast, what we're going to deliver for the rest of this year and what we're going to deliver into in through 25, just before the end of this year, we've got Squid Game return, we've got Emily in Paris return, you've got a new season of Selling Sunset, Lincoln Lawyer, The Diplomat, Virgin River, Love is Blind. Ryan Murphy has an incredible new season of Monsters that tells the Eric and Lyle Menendez story. That's all just coming up before the end of the year. And then looking forward, the next, through 25, you've got new seasons of Wednesday and Stranger Things and Night Agent. We're in production on One Piece. So there's a ton of excitement there just in our series. This week, we kicked off the finale of Cobra Kai, which is going to blow your mind. August 8th, we've got the finale of Umbrella Academy kicking off. And a brand new series that we're also thrilled about, Susan Beer's Perfect Couple, this has got Nicole Kidman and just a really fun thriller. Nobody Wants This from Kristen Bell and Adam Brody. Black Doves, a beautiful show out of the UK. Beauty in Black from Tyler Perry. No Good Deed, which is bringing Ray Romano and Lisa Kudrow back to TV. Classic Spy with Ted Danson. From Brazil, we have Sena. From Colombia, we've got 100 Years of Solitude. And then, of course, all those live events I taught you about. And our movie slate is fantastic with Rebel Ridge, Will and Harper, the 6888, The Piano Lesson, Carry On. We have got a lot packed into that. Our goal and our mission here is we have to spend the next $1 billion of programming better than anyone else in the world. And there's no one better at doing it than Netflix. So we're excited.
Spencer, how do you not get excited about that? And then also get excited about that we're going to do all that while, growing content spend slower than revenue. That's a lot of stuff going on. Thanks to
It's all in there. It's all in there. And the hot dog contest too, Spence. Don't forget that.
All right. Well, I'm going to leave it at that since it sounds like we're going to have a lot to watch. So we all need a little bit more time. So we'll end the Q2 call here. So thank you, Ted, Greg, and
Dude, that was the best way I've ever heard a call in. That was great. Dude, you could tell he's the CEO of the company. He was listing like movie titles the way I randomly list Palantir contracts from a year ago, because you're in that zone, right? You've studied the stuff, you know about the stuff, you're talking about what you're excited about. Netflix stock right now after hours, doing good. Look at that, up 1.28%. And they said at the end, we're increasing that engagement, increasing the content output, decreasing the spend. which is what the street, I'm assuming, wants to see, which is why we got a nice reversal from 600 at one point back up to 652, really bottomed at that 625 range, now up 2% after hours as well. Not bad. All that matters is that Netflix didn't collapse, that big tech earnings are starting off with a good performance by Netflix, even though it's up almost 40% year to date. And we got to see how the rest of these companies play out over the next couple weeks. All right. That's it for me. Thank you, everybody. We'll be back tomorrow for the market open on Friday. Money market fund update did come out during the earnings call. It increased by 9.6 billion. So we're back to an all-time high, 6.15 trillion on the money market funds. I'll have a daily Palantir episode coming out in about an hour on the deal that Palantir made with the state of Bavaria in Germany. So we'll be talking about that. And then we'll have TJ on tomorrow in the morning discussing options and everything going on from there. Trump will be speaking tonight at, I think, 10:30 to 11. I won't be able to stream it live, but tomorrow we'll cover it and we'll see what they said on the speech. And we'll see if potentially Biden drops out tonight. We'll see how that plays out going into the RNC later today. All right. Yeah, and I'll be on Twitter. I'll post the pic of me and Chris. We got to have a good comment. Palantir bull, Palantir bear gets sushi together. We got to get a good caption on that one. So Twitter in the chat. And I'll be meeting up with Chris tonight and sharing that later today. All right. Thank you, everybody. Appreciate it. We'll be back tomorrow morning, 8:45 a.m. Bye, everyone. Have a good one.